ahead and tell you what we're going to go through tonight. Specifically, that's the buying property subject to the existing financing strategy. How many of you all have heard of that strategy? How many of you guys, okay, some of you guys, and some of you are more experienced real estate investors in the room, which is perfect. The more experienced you are, the more likely that you've probably heard about this. I'll go ahead and go through the presentation. You guys will just have to listen until we get the tech right in here, so apologize for that. But for us, buying subject to the existing financing has been probably one of the most powerful strategies that we've used as real estate investors since we've been investing. I'll kind of break down the strategy in terms of how you actually work it through the course of this presentation. Just to give you an idea, when you purchase a property and there is a loan associated with that property, the original owner signs the deed over to you. That is a recorded document, so that is notarized and recorded at the county. And there's two other documents that are also part of it as well. Number one, it's the promissory note, and number two, it's the deed of trust. The combination of the promissory note and the deed of trust allows for what we call a non-judicial foreclosure in the great state of Texas. So that basically means they don't have to go in front of a judge, go in front of a court to get permission to be able to foreclose on you later on. So that's something that we've used really well in Texas. We have some of the shortest foreclosure periods in all of the great United States. For example, if you're trying to foreclose on someone who is in Florida, you may, for example, be trying to foreclose on them for 2 or 3 years before it actually gets through and actually gets to foreclosure. Versus here in Texas, it's a very different story in that you can foreclose on someone. It's really, the minimum notice is 21 days. It actually takes a little longer than that to go through all of the other notices that you have to do before you get to that 21-day marker. But Texas is one of the fastest to foreclose states in the country. Now, because all of those security instruments, if you will, are filed separately, you can take the deed to a house without paying off the underlying lien. So when you buy a property subject to the existing financing, the deed transfers from one party, the original owner, to you, right? So that owner signs the title over to you. But the original loan that original owner or that current owner has in place, that loan stays in place, meaning that loan is not paid off. On a typical transaction at the time that you sell a house, the loan is paid off, but when you purchase a property subject to the existing financing, that loan is not paid off. But what we do is we create something called a wraparound mortgage. A wraparound mortgage is what gives the seller protections in the event that the end buyer stops making payments on the original owner's loan. So we create this wraparound mortgage, which includes a new note and a new deed of trust. That's what allows a seller to foreclose on an end buyer in the event that an end buyer stops making payments on that transaction. So it basically gives them the same power as a Wells Fargo, Chase, Bank of America, etc. So it's a very powerful strategy that we have used ever since we started investing in real estate back in 2003. In fact, we own many of our rental properties we bought subject to the existing financing. So the deed transferred to us or one of our companies, but the loan stayed in place with the original seller. So we're now making payments on that seller's loan. One of the properties we took all the way through the amortization schedule and paid off, but most of the other ones we're still paying off on a monthly basis. So for us, what we've seen, this is a great strategy, again, to be able to buy rental properties, to buy homesteads, to buy fix and flips, to get properties under contract and even wholesale those properties to other investors because it comes with the financing included. Usually when we're buying properties in this manner, we're only bringing a reinstatement to the table. So the reinstatement is typically anywhere from $10,000, $20,000, $30,000, $40,000 on, for example, a $200,000, $300,000, $400,000 house. So instead of us having to bring that full $200,000 or $300,000 or $400,000 to the table in order to purchase the property, oh, thank you. I appreciate that, guys. Instead of doing that, we're only bringing just a smaller amount of money, usually the reinstatement when we purchase the property. For us, it's been a great way to pick up rental properties, to pick up properties that we bought to buy and fix and then quickly resell, so our fix and flips. It can also be a great strategy for homesteads. We've got a lot of colleagues who have been real estate investors for a very short amount of time who are buying their own homesteads this way, because many times early on, when you do not have that proof of concept of you being a real estate investor for more than 2 years, it's really hard for you to get a loan. If you've changed jobs, if you've changed industries and you haven't been in that industry for at least 2 years, a lot of lenders don't want to give you a loan. So for real estate investors who have that creative knowledge and know-how and have not maybe been investing for long enough for it to be on their tax returns, or for us as real estate investors, we obviously, and any business owner, you try to write off as much as you can. So it looks like you might earn a little less than what you actually earn. The details can get a little complicated. We're going to walk through those details tonight. But for our long-term holds, we just want a low fixed rate interest rate. For our short-term fix and flips, we don't care even really what the interest rate is, as long as it's less than what we might have to borrow money from someone else. So those are the big things that we look for specifically. We want you guys, and we do still 14 and a half years later, we close at a title company every time we buy a property. Title company reviews all of our documents and creates all the documents for closing. We highly recommend you guys do the same. I know a lot of you guys are getting lessons from people who are out of state. Gilbert, yeah, I'm talking to you. A lot of you guys are getting information off of the internet and maybe listening to internet gurus, if you will, that maybe invest in other areas other than Texas. They might be recommending specific contracts, they might be recommending specific strategies, but those contracts and those strategies may or may not work here in Texas. So highly recommend close with a local title company who understands these transactions to make sure that you're successful at it. So some of you guys who are familiar with this strategy are also familiar with what's called the due on sale clause. Can anybody in here explain what that is? I've got it written up here, but is anybody in here worried about the due on sale clause when it comes to buying rental property, homesteads, fix and flips subject to the existing financing? Anyone? What is that? What is the due on sale clause? I'll read it for you. I have it memorized, at least the good parts of it. It basically says, in the event that this house is sold, and in the event that at the time of sale this loan is not paid off, the lender may, at its option, call the note, the underlying existing loan that from Wells Fargo, Chase, Bank of America, etc., they may call it due. It's at their option, and they may do it. But for us, what we've seen in our experience and all of our other investor colleagues, knock on wood, who have been doing it for a while, no one has ever had a note called due, because what they do each and every month is what? They make the payments on that loan. Wells Fargo, Bank of America, Citi, Chase, what do they care about? Do they care necessarily who's making the payments, or do they care that the payments are being made? So from our experience, what we found is that even though just about every mortgage has a due on sale clause, it's very rare that a loan gets called and accelerated because of the due on sale clause, because as long as you're making your payments on time. There are some tricky ways to kind of get around this. There's something called the Garn-St. Germain Act of 1982. It gives us a little bit of protection and a little bit of air cover when it comes to transferring properties into other entities. And it gives us a little bit of the staging for using this strategy as well. I'll tell you how we buy them as well, just so you guys are familiar with it, and give you some ideas about how you can use it in your investing as well. The steps to buying a property subject to: first you have to actually do the marketing to find the property. Then you explain to the seller that you're going to be buying their property by taking over payments on their existing loan. The deed will transfer to you, the investor, but the note will stay in their name, and you, the investor, will be the one who's making the payments on that note going forward. You will have some objections to overcome in about half of the situations. And what I found is that most investors have more objections in their head that get in the way of the conversation that they're actually having with the seller, way more than what the seller has in their head when they're thinking about this. Usually the people that we're talking to have some type of a serious motivation, need to sell their property quickly, and need your help as a real estate investor to do this. This is one of the creative strategies that we use as a real estate investor. to be able to keep our powder dry, which when we say that, what we mean is this. Let's say, for example, you only have $200,000 to invest as a real estate investor. You can spend that $200,000 in Austin, Texas in a heartbeat, right? Average price, median price in the city of Austin, $400,000, average price in the city of Austin, $500,000. Like, you could just spend this very quickly. But if you're buying property subject to the existing financing, then instead of putting all of your $200,000 down on one property, you might only have to reinstate on a few different properties. So you may instead be only paying $20,000 to reinstate and have your hands and your profits in 10 properties as opposed to one property. Does everybody understand how powerful that can be? It can really extend your buying power and let you do a lot more deals with the same amount of money. For us, we get the property under contract. We use what we call a TREC contract. If you are not familiar with contracts, you guys can get the TREC contract for free. It is written and created by the Texas Real Estate Commission, TREC. On their website, if you go to TREC, just Google the website. The website's something like trec.us.tx.gov. What the hell were they thinking when they came up with this URL? Approximately exactly. So just Google TREC. It's the first thing that comes up, TREC. When you get to their site, you'll click on forms. There are about 40 different forms, addenda, amendments, etc. Look for the form if you're buying a single family house that says 1, 2, 4 family contract. That's what it's called. There are about 40 other contracts, addenda, notices, etc. on there, but that's the one you want to look for. When you're buying a property subject to, you also have to fill out some additional forms. You also have to fill out a subject to addendum. This puts everyone on notice that you're buying the property and you're keeping the existing loan in place, and goes through all of the details on that. You'll take your contract over to the title company with your earnest money. They just updated the TREC contract effective February 12th of 2018, so make sure you're using the right one. If you've been investing for a while and you just keep a PDF in your documents, for example, you'll want to update that because title companies stopped accepting the old document, the old TREC contract, this past May 15th. So use the TREC contract, get that contract, that sub-2 addendum over to the title company. They'll start the title research on it, and they will prepare all of the paperwork for you in terms of preparing the deed to transfer ownership from the prior owner to the current owner, to you, the investor, and do the wraparound mortgage creation, which basically gives the seller a new note and a new deed of trust that you sign off on, that gives that seller the ability to foreclose on you in the event that you stop making payments as an investor. After you buy the property, you'll maybe reinstate the loan. You'll probably pay for closing costs. Then you'll go and fix the property, and then you'll later put it on the market. When you later put it on the market, you will request a payoff of that existing loan, and then you'll pay off that loan at the time that you close to your end buyer in the event that you're fixing and flipping it, or you'll just continue to make monthly payments on that property if you are keeping it as a rental, which is what we've done with many of ours. So again, exit strategies: buy, fix, and flip, buy and hold, keep as a homestead, even create a wraparound mortgage to sell to another buyer, maybe an end buyer, a retail buyer who has money for a down payment, who has money for the monthly mortgage payment, but maybe does not have the credit to be able to purchase a house using the traditional means. Some of the objections that we typically see is most of you guys would say, I'd never sell anyone my house subject to the existing mortgage. Why would you say that you would never do that? What worries do you have? No one has any worries. Great. Really? You're worried I'm not going to pay. That's what most people are worried about. But here's what I want to tell you. So most people get in their own heads saying, I would never do this because I would be worried that someone would affect my credit and someone would not end up paying on my mortgage. And that is true. But most of the people that we buy from, what situation are they in? They have already been the ones who have screwed up and have not paid on their own mortgage, right? So we're actually reinstating and giving their credit an opportunity to get better because we reinstate the loan and we make the payments on time going forward. So Pardon me. So yes, if you're dealing with someone who is has perfect credit and is not behind on payments, which we don't deal with usually as real estate investors, yeah, you're going to have a hard time selling this subject to strategy. But if you're dealing with someone who's on the foreclosure list, maybe days away from foreclosure, maybe, and I talked to someone today, I was talking to another investor today, and they were they had a lead, and that owner stopped making payments, and I don't know how this happens, but this is not an unusual story, but stopped making payments 6 years ago. 6 years ago. Do you think that person is worried that, oh yeah, if I sell it to you, you're going to ruin my credit, right, by not making payments? No, they're not. In fact, if you reinstate that loan and now make payments on it going forward, you actually help their credit. Now, they've taken it pretty far down, so you've got a long road to hoe on that, but it's definitely an opportunity to work that strategy. Now, remember that most of these people that we're talking to, some of them have little or no equity. Most of them, in fact, are behind on their payments. In many of these cases as well, the property needs to be rehabbed. Many of you guys are thinking, well, the values have been going up, 5 to 10% a year over the last 5 years. There's, why can't they just put it on the market? Why can't they just sell it? There's a ton of equity. Yes, there's a ton of equity, but equity does not equal cash, and at the end of the day, it still takes cash to be able to do the renovations necessary to take advantage of the equity that's in that house. And some of you guys are saying, well, why don't you just get a home equity line of credit? Well, if you don't have a job, or if you don't have credit, a good credit, or if you've been missing payments on that loan, the possibility of the bank giving you a line of credit to make all these repairs is basically slim to none, right? So these are the specific situations where we come in, where we opportunistically use this strategy to be able to help some of these homeowners that are in this situation. Again, facing foreclosure, if they wanted or needed to sell quickly, and occasionally you get some of the weirdest stuff. Like you'll have an owner that says, "I just don't want to list with a real estate agent because I don't like agents, or I don't want to have my house on the market. I don't want multiple people coming through my market. I don't want anybody coming through here doing inspections. I don't want them to have a long option period. I don't want to renegotiate it. I don't want them to ask me to do repairs. I don't want to have to be worried about whether or not a bank's going to actually provide the financing on this house because the house is in bad shape." So these are some of the different situations where we come in as real estate investors and we're able to help some of these homeowners. Some of the typical objections. Again, why would I buy your house, bring your loan current, and then stop making payments on your loan? Why would I spend $20,000 reinstating your loan and spend $50,000 maybe renovating your house and then stop making payments? If I wanted to lose $70,000 as an individual or as a business, there's a place that's much more fun to do it in. It's called Las Vegas, Nevada, okay? I'm going to take my $70,000 and I'm going to go and do that there. I'm not going to do that on your house. That would not be fun for me. This is a business that I am in. This is a strategy that I use so that I can even do more business. Let's see. Working with me and stopping foreclosure today is better than risking it in the future. I'll be rebuilding your credit back as I reinstate the loan and make payments on the loan. A lot of people think, oh, well, I'm going to get better credit because this loan is off of my credit report. Well, that's not exactly how it works. If this loan is now off your credit report, but you still have all those late payments on it, your credit score is still sunk. If the only other credit that you have in your name, for example, are small credit cards from Home Depot or Macy's or stuff like that, your credit is not going to be built back up, or it's not going to be built back up very quickly. But if I am making payments on a $200,000 or $300,000 mortgage on time each and every month, then your credit is actually going to be built back a lot faster than if that debt is completely removed from your credit report. Sometimes I add information about my financial stability. We've been doing this since 2003. And then what I love is just having skin in the game, and if I stop making payments, you actually get to foreclose on me. So sometimes I'll tell people I don't know whether you are a religious man or not, but whether you are religious or not, what I can promise you is that every night when you go to bed, you will say a little prayer that goes something like this: after she reinstates my loan and repairs my house completely, I hope she stops making payments. because then I can foreclose on her and take my house back. It's essentially like, you just won the lottery, congratulations. You want me to mess this thing up, right? So doesn't that kind of break the ice a little bit too? So that's one of the ways that we're able to overcome some of these objections. We get to tap in at that moment to their greed emotion, right, in their body. So it's a great way to be able to do that as well, and loosen the tension too. We also have a way to help them get another house in the future, because that's sometimes an objection. We write a letter of explanation, an LOE, as they say in the mortgage industry, to explain the transaction and how it's happened here. And guys, just really quickly, because I think we've set everyone up for membership, but I just want to ask if anyone in here is interested in commercial or multifamily investing who has not yet gotten membership yet. Will you please raise your hand if you're interested in commercial multifamily? So if you've not got membership yet and you're interested in commercial multifamily, we have some special commercial multifamily training. And Graham, who's in the back right there waving, he can set you up for that. So he's closing down the membership processing right now. So if you want to go and see him, get set up for that. He'll just see you right outside the door. It'll be very quick, like probably 2 minutes in and out, so you won't miss like a whole lot of the presentation. All right, so some of the tricky details. For us, every time we put a property under contract subject to the existing mortgage, we always verify the payoff, the reinstatement, the terms of the loan, what the monthly payment is, what the interest rate is, what the amortization period is, etc. We do this by using an authorization to release loan information form. I'll show you what that looks like in a couple of seconds, but I'll also tell you can get this is the form you can get online. When a property is just about to go to auction, a lot of times you will actually hop on the phone with the seller and get authorized on the phone with the seller, or have the seller ask for this information, payoff, reinstatement, because you cannot buy a house subject to, or you cannot buy a house subject to without getting the payoff and the reinstatement amount. You cannot buy a house that has a loan on it with or without subject to without getting that payoff statement. So you got to get that, and you think that, oh, well, they're all going to foreclosure, it's going to be another 3 or 4 days. No, it takes these banks a long time to generate these payoff statements, especially when someone's behind, because they have to compute the legal fees, and sometimes if it's already at a trustee's office, at a foreclosure attorney, there's more fees on top of that. And you can't just tell them, well, I'm 5 months behind, the monthly payment is $2,000 a month, that's $10,000. How about for all these fees, I just write you a check for $15,000 and we just kind of figure it out later? No, there's none of that. It has to be the exact amount to reinstate it, otherwise they're going to kick that payment back. For us, when we buy these properties, we buy them in the name of our LLC. So we usually set up a different LLC for every property that we are buying to buy and hold. And we set up a specific naming recognition for those LLCs. We set it up as the last name of the original owner dash the street name of the property. What do we know about that LLC name? Have you guys called the state of Texas to get a company set up? And have you said like, well, is Austin Homebuyers available? Oh, it's not? Okay, well how about, is Texas Homebuyers available? Oh shoot, it's not? But if you call them and you say, is Gomez-1234 Main Street available? What do you think they're gonna say? It's a miracle. It's the only name that you picked, yes, and that is available, right? So what we know is that LLC name is always available, so we actually will put that LLC name as the buyer even before we have that LLC, because number one, we know it's always available, and number two, we don't want to go through the full process of setting up an LLC until we know for sure we're going to close on Nelson Gomez's house at 1234 Main Street. Because think about if you set up that LLC like 3 weeks prior, and then Nelson didn't end up selling it to you, and now forever you have Gomez-1234 Main Street LLC, and you're furious about it because now you got to put other properties in it. So this is a little trick that we use. The other great thing about this trick is for banks, you know, we haven't had one who goes to check to see, whose name is this property in? All they check to see is, are the monthly payments being made, right? But if they ever did decide to download all of the deed information for the 254 counties that are in this great state of Texas, let alone all of the counties that are around the country, if they saw that Shinoa Grove was the deed holder on Nelson Gomez's loan, they might say, I think there might be something funny going on here. But if they see that the deed holder for Nelson Gomez's loan is Gomez dash the property address, what are they going to think? Family planning, which falls under the Garn-St. Germain Act of 1982. It's pretty clever, right? So this is something that we've been using since we've been investing since 2003. It's something I recommend for you guys too. Now, for our short-term buy and holds and for y'all short-term buy and holds, and I'm not an attorney, CPA, or financial planner, but what we do is we actually put them in our fix and flip entity because we know we're not going to be holding that property long enough if we're buying, fixing, and flipping for a bank to say, hey, wait a second. Oh no, that's okay, we already got it sold. Don't worry about it, right? So that's one of the strategies we use. Other tricky details, we always get a new insurance policy. The insurance policy is where most new investors mess this up because they'll get an insurance policy in their own name, but they won't name the original owner as an additional insured. And the mortgage companies will say, well, wait, what? And no, we gotta make sure that the owner is on here. And a lot of times they won't name the mortgage company as in the mortgagee's clause is also protected by this insurance policy. And the mortgage company is going to say something about that, right? So those are the things you need to do to protect yourself. You'll verify all liens on the property. You'll do that through the title process. You will close it at a title company. Also, understand the terms of the existing mortgage. Sometimes there are balloon payments, sometimes, and very rarely at this point, but we used to see a lot of them in the last mortgage cycle. We will see them again in some other cycle in the real estate market, but sometimes you'll see adjustable rate mortgages even still today. Sometimes you'll see early payoffs, sometimes you'll see shared appreciation mortgages. There's some odd stuff in there, so be sure to verify that. You will take a look at that note in deed of trust, and the title company will need that note in deed of trust to go through that verification process. You'll also, at the time that you purchase the property, you'll want to change the mailing address to your address because every March, what does your mortgage company do? They do an escrow analysis. And they tell you, dear Shinoa, you can either write us a check for $600 because your escrow is underfunded, or you can increase your monthly payments by $50 a month. If you're not getting these statements because you didn't change the mailing address, then now you might be getting behind on this loan and not even know about it. So always change the mailing address. It's also good for escrow checks and 1098 interest expense statements. So if it is a rental property, for example, for us, we write off the interest that we pay on our rental properties. So we want to make sure we get that 1098 interest statement to know how much interest we're actually paying on that property. So that's another reason to change the address. Now some people say, well, wait a second, isn't that 1098 interest expense statement, doesn't it have someone else's social security number on it and someone else's name on it? How can you take it off of your taxes? Well, I've talked to my attorney and one of my real estate coaches about it when we first started doing this, and they said, well, because you are the one who is making those payments on that loan, you're making both the principal payments as well as the interest payments, that you are the one who gets to take that interest expense off on your tax return. So I said, okay, I trust you. You are my coach, you're my advisor, you're my CPA. You say this is correct, I'm going to go do this. So for years, we did this. But about 5 years ago, we got a love letter from the IRS that said, dear Shinoa, your social security number is 1234567. Shinoa, what we don't understand is how come you're taking off the interest expense for all of these other social security numbers. And Shinoa, because we believe you've screwed something up quite big, we went ahead and took the liberty of creating an invoice for you for all the money that we think you owe us plus penalties. That's how those letters go, if any of you guys have ever gotten them, right? Except without the love, the IRS part, right? So I saw it and my heart sank. And I started to panic, and I called my CPA, and I'm like, oh my God, I got this letter from the IRS, it says I owe like $50,000, what am I gonna do? And he was like, calm down, it's okay. Here's what we're gonna do. So we went back and collected all the HUDs, made copies of them, the settlement statements. We went back and got all the copies of the 1098 interest expense statements, and we wrote a letter to the IRS saying we bought these properties subject to the existing mortgage. We are the ones who are making payments on this property. That's why we are the ones who are taking the interest expense on this property. So we sent all that documentation along with that letter to the IRS, and the IRS wrote us another love letter that said, Dear Shanoa, we're good. See you next time. And I said, oh yeah. So I stepped out of my ivory tower of teaching and talking about it, and I'm just going to say, you're welcome. Okay, just in case you were preparing that big thank you, you guys are welcome. So tested, but you do have to make sure to be able to get this right. You have to have a copy of that 1098 interest statement. Otherwise, you are not going to be able to write those off. Period. And that's why you changed the address. A sample copy of the authorization to release loan information. Again, this just states that you, as the investor, have the ability to call the lender to get the payoff, to get the reinstatement, to get the interest rate, to get the mortgage term, to get the monthly payment, to get the escrow analysis, etc. You can find a lot of these online. In fact, some banks have their own authorization to release loan information forms, and they won't use a generic one. You have to use theirs. So just be ready for that as part of your process in purchasing these. For us, what we found as some of the advantages is the loan's not in your name, but the deed is, meaning you control the property as the real estate investor. For us, again, we usually buy these in an LLC. If we're keeping them as a rental, we do have a naming recognition that we use every time. That's simple to be sure to get that LLC with the state, and also looks like it falls under the Garm-St. Germain Act of 1982 that allows for some family planning and allows you to take a property subject to in that family planning. For us, because we are in Austin, and my person from Killeen, I don't see her anymore. Okay, I was thinking that you probably already started to truck back to Killeen because it's going to take you all night. Okay, yeah, okay. So for us here in Austin, we specifically for our rental properties, we look for higher appreciation neighborhoods. Now, the rising tide has raised every single boat here in Austin and Central Texas and almost all of Texas in general. So we want to look for the areas that will be appreciating even beyond the current up market cycle that we're in right now. The tenant pays down the loan for you, which is fantastic, but you get all the appreciation. For us, buying properties this way has been the essence of wealth creation for us because, again, it's a great way to extend the limited capital that you might have and allow you to invest in multiple properties instead of just one property. And for us as well, because we have so many rental properties, at some point, banks don't want to give you loans anymore. Usually that's around 4 loans. Some people will say, oh, well, I'll give you up to 10. And we do have some of our hard money lenders that are vendors in the association that will give you even more than that, obviously, but those rates are a little bit higher. For us, we like to take over someone's loan where the interest rate is 3, 4, 5, 6%, right? It's a great way, again, to be able to leverage the capital, leverage the credit that someone has already put forth, and use that to be able to purchase rental properties and to be able to experience that appreciation and build that wealth. The truth about buying subject to is that a lot of people don't believe that, I would never sell anybody my house subject to. Yes, you probably would not, because you have the perfect life. You have a job, you have your spouse, you have a truck that's running, you have a dog that is alive. You are not the subject of the next country and western hit, okay? But for the person who is the subject of those types of things going on in their lives, this is a perfect strategy to be able to buy houses and really help them out along the way as well. It does get a little awkward managing someone else's loan when it comes to making the changes in the payments. when it comes to when some of these loans, the servicing rights get sold. So for some of you guys who have had a loan, originally when you got it, it was with Wells Fargo, then it was sold to Citi, then it was sold to Chase, then it was sold to this person, that person, and you've got to kind of always be making those sorts of updates. You would as well if it were your own loan too, but something to think about. But our advice, our suggestion, and what we do every time someone brings me a deal, I always ask them the same question, which is, can I get the loan with the property? Can I take over the owner's existing loan to be able to purchase this property? Because if it's a $200,000 purchase price and all I need to do is bring $20,000 to the table to reinstate a loan and pay closing costs, I'd rather do that so that I can do 10 properties with a $200,000 savings rather than just one. Do you guys see how powerful this is? And again, some of the details are complex. You don't have to worry about knowing how to do every part of it because the title company and attorney is going to close this for you, and they're going to fill in all the fine little lines and cross all the T's and dot all the I's for you. So I hope this gave you guys an introduction to some of the other strategies that can work for you as a real estate investor and can help make you money and save you money as a real estate investor. And I just want to thank all of you guys for coming out tonight and bearing with us through all of the technological difficulties that we had tonight. And we'll see you at our next meeting, which will be the first Tuesday of next month. Have a great night.